So, welcome back to Chapter 13, Part 2. Chapter 13, Part 1, we dealt with the concepts of depreciation, amortization, and depletion, and we also talked specifically about the depreciation of tangible assets, and as well as the cost of how we arrive at the cost. So now we're going to move on to intangible assets, things we can't touch. So intangible assets are intellectual property, and they are treated very differently in terms of how they get onto a balance sheet. This is very confusing, and there's much discussion within the accounting profession if this is the way it should be done or not. And this is one of the big differences between U.S. accounting, GAAP accounting, and international accounting. So under GAAP accounting, we record intangible assets only if we buy them from somebody else. So if I buy a patent from another company, I'm going to record it at what I paid for it, or an individual, an inventor. However, if I employ scientists and engineers to work for me and they develop a patent, then I don't record it as a purchase, and their salaries I expense. I don't capitalize them. So two companies with the same type of assets, patents, with somewhat similar values, one might have them on their balance sheet if they bought them from another company, and the other won't if it developed it internally. Same is true of trademarks and copyrights and so forth. So if you look at Coca-Cola's balance sheet, you're not going to see an asset on there for their trademark, and yet their trademark is quite valuable, and they spend a lot of money in advertising and promotion to maintain the value of that asset, that trademark asset, as well as creating new value within that trademark asset. So that trademark doesn't show up on their balance sheet because it was developed internally. However, if some other company went and bought Coca-Cola or bought the right to use their name, then they would have that trademark on their balance sheet. So that makes, for reading financial statements, you've got to be careful. What does this company own that doesn't show up on the balance sheet that might have value? So that's the rules. Internationally, it's not the rules. Companies are sometimes, not always, but sometimes allowed to capitalize their research and development on their balance sheets. So think about a company like a drug company that spends millions or billions of dollars developing a new drug. U.S. companies that do that expense all of the research and development as it's incurred. So the scientists working away in the labs for 10 years to develop a new drug, each year their salaries and the cost of the lab is expensed. Then eventually, let's say they do develop a marketable drug, all of the income from that drug, we're not matching the expense of developing the drug with the income. So we're going to show large losses until such time as we develop a drug. We're not going to capitalize it. The accounting justification for that is that when people are working in a lab trying to develop a new drug or invent a patent or whatever, we don't know if they're going to be successful. We sent them out there, we spent a lot of money, but we hope they're going to find a new drug or invent a new something, but we don't know. So the conservative accounting approach is, well, if we don't know there's going to be anything of value here, we certainly don't want to capitalize it and call it an asset. We want to expense it. And that's the accounting approach that the U.S. takes. That's the GAAP accounting approach. And since we're in the U.S., that's the accounting approach we're going to talk about and learn. But just realize that there are lots of discussions about whether that's a valid way to account for intangible assets or not. So intangible assets generally many of intangible assets have useful lives, and they are amortized just the way we depreciated fixed assets, except that we're required to use straight line for amortization. We're not allowed to use any of the other methods, so it's just straight line. So anytime we can determine the life of an asset, of an intangible asset, we amortize it. But some intangible assets don't have lives, so we don't know how long they're going to last. So trademarks, Coca-Cola's trademark, as long as they continue to renew their trademark every 10 years, it will last forever. There's no time limit on their trademark. So trying to do straight line amortization for something without a life, without a useful life, pretty difficult. What's my denominator of my equation going to be? I'm going to take the cost and divide it by what? Well, I don't know. I don't know what I'm going to divide it by because I can't estimate the useful life. Same is true of goodwill. We talked about goodwill a little earlier in the class, earlier in some earlier sessions. Goodwill also has an indeterminate useful life. So we can't determine how long it's going to last, so therefore we have to do something different. And what we do is we look at goodwill and other intangible assets that have indefinite lives at the end of each year and say, are they still worth what we paid for them? So we bought a company and we acquired goodwill. Is the goodwill still there? And if it is, then we leave it. If it's there or it's greater than it was, then we leave it at what we paid for it. If it's not, then we have to write it down, and that's called impairment. So if the asset has been impaired in some way, then we have to write it down. So we don't do amortization for those kinds of assets. We only do amortization for these kinds of assets. So we have to estimate the life, estimate its residual, which actually estimating life for intangibles is usually pretty easy because it's usually contractual. So the patent's going to expire in 12 years. I bought a franchise agreement that lets me do something, and the contract says it's good for 10 years. So we know the useful life is usually quite easy to determine for intangibles. And generally there is no residual value, but if there is a residual value, you use it in the calculation. So cost less residual value divided by the number of years left in its useful life. That's pretty easy. So straight line. If they're not subject to amortization because they have indefinite lives, they're reviewed annually and they're declared to be impaired. If impaired, they're written down to their new value. So that's intangibles. We've whipped right through that. So now let's talk about natural resources. So natural resources are things that come out of the ground, except accountants consider timber to be a natural resource as well. So generally natural resources are non-renewable. So once you've taken the oil out of the ground, it's gone. It doesn't grow again under there. Same thing with coal or gold or silver. Timber, however, does grow. But accountants look at the length of time it takes timber to grow and say it's a depleted resource. You cut the tree down, it's going to be 20, 30, 40 years before you have another tree in its place. So therefore, this is a depletable resource. And we treat it exactly the same for accounting purposes as we treat oil and natural gas. Since we're sitting in Maine, which has lots of trees, it's good to think about that. So ExxonMobil has lots of oil reserves, which are a natural resource, and they go down every time we take oil out of the ground. So understanding how that works is really important. So how does the cost, let's go back here, how does the cost get on the balance sheet in the first place? Well, ExxonMobil and other oil companies will pay for lease rights to the natural resource holder. So if it's offshore oil in the Gulf of Mexico, the bottom of the ocean is owned by the U.S. government out 200 miles. So for mineral purposes. So since that's the case, if ExxonMobil wants to drill in the Gulf of Mexico, they have to pay the U.S. government for the right to do so, which is called an oil lease or a mineral lease. And they usually do that at auction. So let's assume that they do that. Their geologists look at the bottom of the ocean and say, hey, we think there's oil in this sector, let's bid on it. The U.S. government holds auctions frequently or fairly frequently to sell off oil rights, mineral rights. So they bid on those mineral rights and they win. And let's say they bid $10 million for a certain section of the bottom of the Gulf of Mexico. So now they bid on it. Now that $10 million becomes the beginning of an asset. It's called an oil reserve, and we're going to credit cash because we're paying cash, and we're going to debit oil reserves. Then we're going to hire a bunch of Maine maritime grads to take a drill ship out, and do an exploratory well. And they're going to drill an exploratory well and see if the oil that the geologists thought was there is really there. And let's say that costs $40 million. So now we spent $50 million, and lo and behold, they drill the exploratory well and they find oil. Great. So now we've got $50 million on our balance sheet as an asset called oil reserves. And then we now have to build a production well and all of the infrastructure around it before we can actually take the oil out in commercial quantities. So we now do that, and by the way, my numbers are just so that I can do them in my head and you can do them in your heads. We have $50 million, and then we spend another $50 million building our production facility, the production well on a platform. And once again, we hire a bunch of MMA grads to operate the oil platform. So at this point, we spent $100 million on this oil field, and we're going to start extracting oil. But before we extract oil, we're going to do exactly what we did with the juice machine. We're going to say how many barrels of oil are down there, as opposed to how many glasses of juice can we drill. We're going to say, I'm not going to drill it. How many glasses of juice can we squeeze? We're going to say how many barrels of oil can we extract from this well. So our geologists get busy again, and they do their estimating. They do what geologists do, and they say, well, we think that there's 10 million barrels of oil in that well that's extractable, that we can get out. Not how many are there, but how many can we get out. So there's 10 million barrels. So we start pumping. In year one, we pump 1 million barrels. It's exactly the same process we did with the juice machine when we figured out how many glasses of juice. Here we know we can get 10 million barrels. We have $100 million cost. Every barrel that comes out is going to have a depletion cost of $10. So if year one we take 1 million barrels out, we're going to reduce the oil reserves by 10 million and charge a depletion cost to our expenses of $10 million. It's not the only expense for getting the oil out, just like the glass of juice was going to cost more than 5 cents. We have to pay those MMA grads, we have to move the oil on shore, we have to have our whole supply chain and all of that, and all of the supplies and other things we need to get the oil out. But we're going to expense this long-term asset, this $100 million asset, over the useful life of the oil well, based on how much we take out. So that's what depletion is. Same process as activity-based depreciation. It's the only method that's allowed for natural resources. So it's calculated exactly the same way as units of production depreciation. Cost allocation over time. Depreciation applies to tangible assets, amortization to intangible assets, and depletion to natural resources. They all describe exactly the same process. Allocation cost over the life of an asset. They have different names, but they pretty much mean the same thing, but they're very specific language, so they apply to certain things. The jargon that we talked about way back in the beginning of the class. And then there are 3 methods of cost allocation. There's straight line, which is an option for tangible assets and required for intangible assets. There's activity-based production or production-based methods, which are an option for tangible assets and required for natural resources. And then there is accelerated depreciation, which is only allowed for tangible assets. So if you can get that stuff in your head, that pretty much covers the territory for cost allocation. So the final thing we need to talk about here when we're talking about assets is what happens when we get rid of them. Well, we can do three things when we get rid of them. We can sell them, we can retire them, or we can trade them or exchange them. So when we sell an asset, we will result in either a gain or a loss. When we retire an asset, that's really just another word for saying we're going to sell it for nothing. We're going to put it in the dumpster, or here in Maine, maybe we're going to put it out in the dooryard. We've retired it. It has no usefulness to us anymore, and we don't think that it has residual value, so we just throw it away. We retire it. So that's like selling it for zero, selling it for nothing. And then the third one, the exchange, well, sometimes we trade things. So we have a truck, we use it for 5 years, and rather than selling it, we trade it for a new truck. So those three methods are things that we do with assets when we dispose of them. I'm not sure if I have a slide or I'm just going to talk to this. No, I'm just going to talk to this. So when we sell an asset, it's on the books for, let's say, $10,000. It has $8,000 of accumulated depreciation, so the book value is now $2,000. Let's assume we sell it for $3,000. We're going to get cash of $3,000. We have to take both the depreciation and the asset off the books, so we have to credit the asset for $10,000, and we have to credit debit the accumulated depreciation for $8,000. And then we have to record a gain on the sale of $1,000. So we sold it for $1,000 more than the book value. That results in a gain or a loss. In my case, a gain. Same asset, $10,000 cost, $8,000 accumulated depreciation, $2,000 book value. If we retire it for zero, it's just like selling it for zero. So we're going to do the same thing. We're going to record zero cash. We're going to credit the asset to get it off the books. We're going to credit at $10,000. We're going to debit depreciation $8,000. And we're going to record a $2,000 loss because we disposed of it for less than its book value. If we trade it, we don't report a gain or a loss at all. So when we trade an asset, we're going to take the asset value off the books. We probably are going to give whoever we're trading the asset to, we're going to give them the asset plus something else, usually cash. So when we trade the truck in, we're going to give the dealer that we're trading it to cash plus the old truck. And the value of the new truck that we get is going to be just that. It's going to be the book value of the old truck plus whatever cash we've added into that. So we're not going to record a gain or a loss at all. We're just going to say we paid the book value of the old truck, our value of the old truck, plus cash, and that becomes the value of the new truck. Following this, I'm going to attach a worksheet that you can do some of the problems on some depreciation and amortization problems and depletion problems. I'd like to ask you to do them. This isn't for points. If you would like to submit them, you're welcome to. I will post the solutions next week, but you can do the problems this week, and I'm happy to look at them and comment on them. I'm not going to grade you on them. So you can turn them in electronically or not as you choose. So that's just to give you some idea of how to do it, because you will see some depreciation, amortization, and depletion problems on your first quest, which is just a couple of weeks away at this point. So might be good practice for you. There are some other depreciation methods. The IRS has something called MACRS, which stands for Modified Accelerated Cost Recovery System. Quite an acronym. You don't need to learn that. It changes every year anyway, so if you learned it, you would have a, there's another error, look at that, it should say cost. Wonder who did these slides. Um, um, so they change all the time. So there's no real reason to learn them, but understand that they're there, and they're generally much faster depreciation methods than are allowed for GAAP. So they're very accelerated, at least at this point in time. The reason Congress changes the rules is they change them based on what's happening economically. And we've been through a pretty slow time economically. So by making depreciation faster for tax purposes, you encourage people, or at least Congress thinks you do, and I think they're probably right. You encourage people to buy assets because the cost of the asset is reduced by the amount of tax savings that you get immediately. So you can depreciate your truck very fast, even though it's going to last a long time, and you get to take that as an expense early on in the life of the truck and offset the cost of the truck. So that's why they do it. You don't need to learn it, you need to understand it. And what it really means is that the depreciation you report on your tax return is different from the book depreciation that you report to your stockholders, which means your income is different. You're reporting less income to the tax man than you are to your stockholders. And because accountants want to be open and above board and let you see everything, we end up with deferred tax payments. So we report to our stockholders at a certain level of income, and we report the taxes that would be paid on that income if we had reported that to the IRS. We're actually reporting less to the IRS, so we're paying less tax than our financial statements say we need to. So therefore, we end up with a liability. Eventually, that tax will be paid. It's just a deferral of tax. It's not a reduction of tax. It pushes it off to the future, and we're always happier to pay things later than sooner. So it's an advantage to a company to defer tax. So that's kind of the process we're going to. So you will see on the financial statements review, you almost always see deferred taxes. And that's because we're reporting less income currently to the IRS than we're reporting to our shareholders. And therefore, this is tax that we will owe in the future on income that we earned or have reported to our stockholders this year. So we consider that to be a liability. It's a temporary difference. It's a deferral, and it shows up on almost every company's books. As long as a company keeps growing, then this deferral will not ever be paid. When the company stops growing, that's when your depreciation catches up, and you may go into the opposite. You may pay more taxes than you're reporting to your shareholders, and that eats into that deferral. So as long as you continue adding plants and adding equipment and adding ships or planes or whatever it is that you do, you're going to have a tax deferral because of the way our tax code is written. And I think that pretty much covered all this. It's basically an interest-free loan that will eventually have to be repaid to the government. So that's why we report it as a liability. So that pretty much wraps up this. You will see those practice depreciation problems, and I'll post no, I won't. I'll post the solutions now. You don't have to look at them. The solution will be there. You can look at it. If you have any questions about any of it, please let me know directly, and I will talk you through how to do it. Thank you very much.